Hi, a warm welcome to ExpertsConnect, and I'm your host, Kadian Davis Owusu. Today, we're privileged to have a senior financial analyst, Mr. Gavin Bennett, and our discussion topic today will be about accounting for small businesses. Hi, Gavin, how are you doing?
I am wonderful. How about yourself?
I'm doing great, thank you. So, Gavin, can you tell us a little bit about your background?
Okay, well, I'm Gavin Bennett. I'm Jamaican, as you can see. I'm now living in Canada, cold Canada. I'm
Yeah.
a certified public accountant, practicing accounting for over 15 years. I also have a MBA in international business. I am also an adjunct professor at Humber College here in Canada today, and also have worked in the universities in Jamaica, both the graduate and undergraduate levels, doing finance, statistics, accounting, and Jamaican taxation, all the works.
Wonderful, Gavin. So, Gavin, what are some of the foundational accounting terms that people need to know when they're starting a business?
So there are many accounting terms, but chief among them, you're talking about your balance sheet, your profit and loss. And, those are two of the main, of the four financial statements that are actually produced at the end of any accounting period. But we're going to be looking today at the two, what I call the two foundational, the balance sheet and your income statement. So your balance sheet includes your assets, your liabilities, your equity, and your income statement includes all your income and expenses for a particular period. So when you look at your balance sheet, now if it is that you're looking at your assets, these are categorized as fixed and current. Your fixed assets are all those assets you have that are in monetary value, that are actually going to be used in your business over a long period of time. So you're talking about your machinery, your computer, and these are what we call income generating assets. So, you cannot operate a business without having invested in a building so much. So having invested in furniture, in computers, because those are what your employees or yourself going to be using to generate the income. You're talking about your liabilities now, which are obligations that business will have or would have, incurred because of some past decisions that it would have made. So you would have made a purchase on credit and have not yet paid for it, then that's a liability to be settled in less than a year. So you call those current liabilities. Now, you have long-term liabilities, and you're looking at those bank loans that you would have borrowed that really extends beyond a year, and you have to pay them back. So that's what you call your long-term liabilities. And most importantly, your profit, right? So everybody wants to hear about profit, but we have to understand that a business profit really does not have the charisma of what I call cash, because you having seen a profit in a particular period doesn't necessarily mean that there is cash in the business. So you have to be very careful of the business decisions you're actually making when you're looking at your accounting profit, which is all your expenses deducted from your income you would have made in that particular period. It doesn't necessarily mean that you have the cash, because if it is that you would have credited a service or a good to your client and they have not paid you, the accounting standard stipulates that, especially if you're doing accounting under the accrual basis of accounting, you would have to record the transactions when they occur, whether or not you have received the cash or paid out the cash in expenses. So you have incurred those economic events, and as such, they have to be recorded in the period in which they were incurred. So you having seen a profit in that particular period does not necessarily mean you have the cash. So be very careful of the decision you're making when it comes to your accounting profits.